Welcome everyone for being on, and we'll get started with today's program in about 30 seconds. Okay, IFA friends, let's get started. And welcome today. My name is Mike Lehman from IFA Government Relations. Thank you for joining us. And it was great to see many of you friends in Phoenix at the IFA convention a couple weeks ago. We are pleased to bring you today's IFA webinar on the 2024 Franchising Economic Outlook. Because before you grow your business or make your next investment, today's program will give you a better understanding of the economic landscape for franchising. You will hear how the franchise community has defied economic uncertainties in recent months and exceeded growth projections, and how it is forecasted to continue its upward trajectory in 2024. And you will also hear about options for accessing capital in this environment. So a few announcements before we introduce our two good friends and speakers today. First, as you saw on the screen, thank you to our sponsor, Benetrends, for their support of today's program. Second, today's webinar is being recorded, and that recording and slide deck available on IFA's community site later today, and that page is at community.franchise.org. That's community.franchise.org. And finally, we will take questions, your questions, at the end of this program, or as we can get to them. So you are welcome to enter your questions into the Q&A box at the bottom of your screen at any time, and we will pose those questions to our experts during our program. But now it is my pleasure to introduce our two expert speaker friends today. First, Reg Bird is president of SBA financing at Benetrends Financial, which is a leading financing expert for custom innovative financing solutions for franchise businesses. And of course, we also have Edith Wiseman, who is president of FranData, which is a world-class franchise-focused advisory firm that helps franchise businesses in a host of performance areas. And our first speaker this afternoon will be Edith, so I will turn it right over to her, and welcome, Edith.
Thank you, Mike. To lay the foundation, I just want everybody to know who they're hearing from today. We are the franchise brainiacs. I'm sorry, Reg and Mike, I didn't have an opportunity to get you a t-shirt. And I'm coming you today from Asheville, North Carolina at a lender conference. And I think what I'm hearing here actually reflects a lot about the franchise economic forecast. So on the one hand, I'm hearing from lenders, they have robust pipelines, really strong borrowers that are coming in for loans. Yet at the same time, SBA officials are saying deferments are up twice as much as they were last year. So I'm going to steal a line from the editor of QSR magazine, which I told him I was stealing. So it's all fair that it's been a wild ride. It's going to continue to be a wild ride, but franchising is a stabilizing force. So if you could turn to the next slide. Okay, so when we look at last year, what we see is that franchising exceeded projections. So we were projected to grow as a business model by 1.9%, and we actually grew by 2.2%. And I'm sure many of you are thinking, well, how exactly did this happen? A couple things. The consumer showed up. So both the end consumer and the franchise consumer, because we've had a tight labor market and wages that have outpaced inflation. So there's a lot to unpack in this economic forecast. So I'm going to touch on some of the highlights, but really I would encourage every single one of you to read the report that's specific to your industry or the specific industry sections that apply to you. So when we kind of step out and kind of zoom out, what we see is that there's a total of 806,000 franchise establishments that support nearly 8.7 million direct jobs, 858 billion of economic output. Now, if you need to remember these stats, just remember the number 8. Pure coincidence. Probably won't ever happen again. But it represents almost 3% of GDP. When you look at this chart, what do you see? You see basically consistent growth. There was this year, what we expect is a slight slowdown in each category, but it's still a very encouraging growth story. The total number of franchise establishments are going to increase by more than 15,000 units, or 1.9%. And that's, these are pretty incredible numbers. When you think about one of the fastest growing brands like Jersey Mike's, they opened 300 units. So to get to 15,000, it's a lot of businesses that are being added to the US economy because of franchising. Can you go to the next slide? Right. Franchising's GDP growth will outpace the growth of the US GDP of less than 2%. So how is this going to happen? There's a couple of reasons, but to name a few, when you look at the economic forecast, it covers 8 business lines, which is a broad cross-section of the US economy. And franchising tends to add businesses in the part of the US economy that experience outsized growth. So for instance, did you know that there is a robot franchise? There's also an AI franchise. And what we're going to talk about later is capital. And capital is attracted to the franchise model, which helps to propel its growth. Being here at this lender conference, everybody sees franchising as a more stable form of business formation. Can you go to the next slide? And when we look at the industries that are attracting the greatest number of new brands, it's also in the same categories where the consumer is spending money. So we see personal services, food, and commercial residential services. Can you go to the next slide? But not surprisingly, the same industries that we're seeing a spike in new franchise formation are also the exact same industries where we're seeing outsized franchise growth. Personal services. This is a big category, which encompasses a lot. It has wellness, childcare, doggy daycare, hair care. This category is going to see outsized growth from other industries within franchising of 3%. So I'm just going to call it as I see it. Basically, every lender, every private equity firm that I talk to, they want to lend or invest in personal services. And the reason is because they see very strong consumer trends in this business line. We want to spend money to make ourselves look good and feel good. We want to spend money on our pets, and we want to spend money on our parents. And so this capital that's being attracted both by lenders and private equity firms are helping to shore up these businesses to have better systems, better productivity, and increased marketing efforts. The other industry, or the second industry that is going to experience outsized growth from other industries, is the quick service restaurant category, which is interesting because I think some people think like, can we actually add more quick service restaurants? And one of my recent favorite stories is I was in Chicago for a meeting, and I saw a Jimmy John's next to a Jersey Mike's, and in the middle was a Taco Bell. And I was thinking to myself, how is that actually possible? And I called the manager and just to ask about sales, and he said, we're doing great. Absolutely no impact to our sales with our closest competitor right next to us. So apparently we like our food and we like it freaky fast. Can you go to the next slide? So food concepts, what they understand that to achieve growth in this environment of higher costs, higher labor costs, higher supply costs, higher build out costs, is that it has to produce a better kind of box return on investment. And so the food concepts have been retooling their box to deal with these changes in cost and changes in consumer behavior. So we more off-premise eating. And what we saw is when we compare all of the new food franchise brands coming to market in 2023 compared to 2022, the average startup cost declined by 13%. And the square footage shrunk by 11%. Now, contrast that to, I think it was last year when we were comparing what the startup cost differential between 2023 or 2022 and 2021, and some industries had a 35% increase. So now we're seeing a slightly different trend going in the other direction as brands are trying to retool the business model. But at the same time, we're also seeing this kind of flexibility in all industries. So Data, we just finished a guide for the National Truck Stop Operators Association to help travel center operators think about more than just gas, and to think about franchises that haven't typically been in travel centers. So think about, personal services or wellness, for these operators to be a hub for their community and maybe offer higher end food services. Did you know that a trucker orders Uber from their truck, even when they're at a travel center? So based on our discussions with franchisors, they're willing to meet their potential customer wherever they are. And that means having the business be able to fit in different venues. So we track every single franchisor's initial investment. And one franchisor has 9 different prototypes based on whether it's a freestanding location, a co-branded, trailer, kiosk, you name it. Essentially, this brand is prepared to go anywhere their customer is. 40% of all franchisors have more than one prototype, 11% have 3. Child-related franchise, you can build a center, you can go mobile, you can go in a classroom. 3 different models, 3 different investments that are accessible to a wide variety of potential franchisees. Can you go to the next slide? Now, in spite of all these challenges we face, inflation is starting to come down and interest rates are projected to come down. So the Federal Reserve, as we've heard, has said that it's just a matter of when, not if. So, so the consumer will be left with a little bit more money in their pocket. I think I read recently that the CEO of Wendy's said, consumers are going to feel a little richer. Go to the next slide. And growth is coming from a very broad spectrum of franchisees. So on the one hand, we have a lot of money that's coming into franchising. I think everybody would agree that years ago, it would have been unheard of for a franchisee to have 150 units in 4 years' time. Well, the family office of a former Xerox CEO, her son and college roommate, made this happen, and they are now the largest Jimmy John's franchisee. But I also looked at the profiles of franchisees that just bought franchises last year. So these first-time franchise owners who have a very wide background, an internal audit manager who's buying a sports franchise or a nurse practitioner buying an insulation franchise. So growth is coming from a large cross-section of investors and owners. You go to the next slide. So just because growth is being projected for the franchise industry, it's not necessarily means it's going to be easy. 80% of franchisees report unfulfilled job openings. Wage growth has cooled, but 60% are still planning to increase wages. If we look back to last year, when IFA surveyed franchisors, only 60% anticipated wage increases, but 81% actually did. there's been a slowdown in the ability for franchisees to raise prices. And so there's new concerns about the increased costs of financing and the dramatic increases in digital marketing expenses. So this is leading to margin compression for many, many franchise businesses. Can you go to the next slide? Okay, now before I turn it over to Reg, there's a couple of things I just wanted to, I'll call them myth busting about SBA lending. The first is that I always hear from the franchise community is that if you're a small franchise system, your franchisees can't get financing. And I say, well, I can't say what I want to say, so I'll say hogwash. Franchisees from all size franchise systems get financing. Now, when you look at this chart, that's what this demonstrates. So what we're looking at is the last quarter of 2022, which is the latest data available. Wait, what year are we in? 2023. So the last quarter, and you can see that franchisees of franchise system all sizes. Now, clearly, franchise systems that are larger are going to get more financing because there are more franchisees who need it. When I looked at the data for last quarter, there was a franchise brand. I just was looking for one example that had one corporate location, and their franchisees got 6 loans in one quarter. First myth busted. Let's go to the second myth. Can you go to the next slide? The next myth is that small dollar loans don't get financed. Yes, they do. When you look at the SBA lending data, the average loan size decreased, and the number of loans under 350,000, which is considered small, grew. So, in summary, it's going to be a wild ride. Franchising is going to grow. It's not going to be easy. And SBA financing and folks like Reg are going to facilitate the franchise business growth.
Thank you, Edith. Great material. And so now to help you think about some strategies for accessing financing in the economic environment that Edith explained, we have our friend Reg Bird from Benetrends. So welcome, Reg.
Thank you so much, Mike, and thanks to the IFA for putting on the presentation today. Appreciate it. And to you, Edith, for your last comments about myth busting. I really appreciate it. One of the myths to bust as well is that banks are lending, and that's really basically what you said already, Edith. But I can't tell you how many people call us and say, you know, I heard that with the higher interest rates and so forth, that banks have just really tightened up. Well, if you think about it, if the interest rates are going up, the banks are making more money, and therefore, obviously, they're incentivized to lend. So folks just don't see things that way if they're not familiar with the industry like we are. You can go ahead and jump to the next slide, please, Mackenzie. One of the other things that I wanted to touch on, just piggybacking on what you said, Edith, about the growth in personal services and QSR food industry businesses are exactly what we're seeing on a daily basis. So I'm going to share some information with you today that's more about what we're seeing every single day with phone calls from prospects and from banks and what they're looking for and so forth that align exactly with what Edith presented, personal services and QSRs. Also, the brands now are offering many options. And so if somebody is looking for qualification for one of the brand's options of going full-blown 3,000 square foot, full service restaurant, drive-through on each side of the building, and so on and so forth, they may not qualify for that. So brands have gotten very smart, and now they're offering other options where somebody might qualify for a very limited footprint, maybe 800 to 1,000 square feet, no drive-through or drive-through only. There's a lot of different options as you also mentioned, Edith, that brands are offering now. A little statistics, not on the slide here, but the number of loans that the SBA approved, 7A loans, which is the most popular product available for borrowers. The SBA approved loans for lenders in 2022 were 47,678 loans. And in 23, went up 20%, 57,000 loans were approved. The dollar amount in lending was up 1.8 billion from 22 into 23. It's a little bit less than a 1% increase, but speaking to your point again, Edith, about the average loan amount, these figures tie in exactly to that. The 7A loan being the most popular in part is because that product covers most of the project cost. There's another product that a lot of folks hear about and talk about and is somewhat of a misunderstood product is the 504 loan. And in the 504, a borrower is limited in what the bank can actually fund. And so that's why I think we've seen a real increase in the 7A loans versus the 504s. I won't get into the statistics, but in the 504 program, loans were down. The number of loans were down. The dollar amount, therefore, as well was down. Because lenders have found that they can offer very similar, attractive terms with the 7A instead of going the 504 route. So I don't want to get too technical into this, but the point being that we're definitely seeing an increase in the number of loans and the dollar amount in total for the 7A program. The SBA banks, as I mentioned in the beginning, are definitely lending. SBA loans are, in fact, very, very accessible. One of the things that we hear often is a reference to, from our prospects, a reference to the SBA will loan or is not lending and so forth. So we always try to help folks understand that the bank is the one lending and the SBA is guaranteeing what the bank lends to a great extent, a certain percentage of the loan amount. Therefore, that incentivizes banks to lend. This is why the SBA program is so attractive for startups, for example. Try and go to a bank and get a commercial loan for a startup. It's going to be pretty darn difficult. The requirements that the bank will have for doing a commercial loan on a startup are going to be quite a bit more required than what an SBA loan would require. The interest rates are reasonable, again, compared to if there was a commercial loan that you were seeking out. Sometimes we get that question too. Well, why don't we just do a commercial loan? Well, with a commercial loan, you can really count on the interest rate being quite a bit more than the capped interest rate of an SBA loan, capped by law. There are extended repayment terms. There's no balloon payments and so forth. Generally, a 7A loan will have an amortization period of 10 years without a prepayment penalty, which is great. So you can prepay the loan, you can pay it down, you can pay it off, whatever you think you might need to do. We always encourage folks to hang on to as much cash as they possibly can so that they can grow and have that reserve available to grow. But sometimes there's situations you might need to sell the business in 3-4 years. Life happens, things happen. And so it's good to know that there's no prepayment penalty. Right now at Benetrends, our injection amount for our clients, rolling 12-month period, is at about 17%. This isn't a figure that we advertise too often, but I thought I would share it because we're very proud of it in that, well, a couple of things. One, we always try with our clients to have them use the least amount of their money. So when we present a project to a lender, we point out to the lender all of the attributes of this particular prospect borrower and why they don't need to put in a full 20%, let's say. And so we've been successful in getting a lower injection amount. The loan amount to cover the bulk of the costs, I actually already went over that regarding the 7A versus the 504 program. So we can go to the next slide, please. So some significant points about the SBA loan, um, be it the 7A or the 504. A borrower is always going to be required to have skin in the game. Again, a lot of calls we get, folks will say, well, I heard that there's 100% financing. We get that a lot from veterans, and that's a really hard call to have, is when a veteran calls and says, I heard that I could get 100% financing, or that I can finance the injection, which is therefore, of course, 100% financing. And that just isn't the case. Veterans, from what I understand, I'm not a veteran, but you can get a very attractive home loan. Maybe there's not a down payment necessary to get a home loan. I'm not 100% sure. But with an SBA loan, you're always going to be required to have skin in the game. So that skin in the game is the injection or the down payment. It's called a lot of different things. But we really, again, try to make sure that the borrower is putting in the least amount of their capital. We'll also hear that banks will turn people down because they don't have direct industry experience. This is a very misunderstood topic in financing. When folks have gone out and attempted to get financing on their own, this is when we hear, bank told me I have to have direct industry experience. And hopefully they have found us for us to be able to give them the true story, which is that it is helpful. It's not required. However, that said, there are certainly banks out there who do require that. So a lender has their own rules. The SBA says that direct industry experience is helpful. It's not required, but if the bank has their own policy that direct industry experience is required, that's just that bank's policy. So we move to a bank that doesn't require that. Something that's come up recently too is about collateral, because in October, the SBA released some new policies, and one of them had to do with collateral that a borrower needs to secure the loan, usually found in personal real estate. The new rule is that a lender does not have to require collateral on loans that are less than $500,000. But I can tell you firsthand that if you have personal real estate, the bank is going to put a lien on it, regardless of the loan amount. It's very, very, very seldom that a bank will not put a lien on your personal real estate. You need to definitely count on that happening. A borrower's business plan and financial projections are required as well. The SBA has an outline that banks have to adhere to in terms of what needs to be in a business plan, what needs to be in a financial projection. And we'll oftentimes again hear that the franchise is going to be doing the business plan or has a business plan for the borrower to use. Important to understand that the business plan will have about maybe 10% about the brand and the franchise, the business. How did they start? Where are they now? What does their trajectory look like? And so on. The other 90% of the plan is about the borrower. And that's where there's a huge breakdown. We'll get a plan that somebody provides us, and it'll be one from the franchisor, a cut and paste. And it's great information, definitely. And we'll use that when we develop a business plan. The business plan has to be about the borrower. It's a selling tool. It's what the bank needs in order for them to understand why they should be a business partner for the borrower. The bank is going to be investing the largest amount of capital into the business. So they need a plan. They need a business plan, and they need to know about the borrower. And the same goes for the financial projections as well. A very simple rule to remember is that a financial projection needs to go out 3 years. Some banks, not the SBA, some banks require 5 years, depending on the project. The first year must always be a line by line, month by month pro forma. We want to see cash flow statements, balance sheets, break-even analysis, and those kinds of things. So very important to understand what is required in a business plan. A lot of times folks will say, oh, I wrote a business plan for my master's degree. I've written business plan for this or for that. But the big question is, have you ever written a business plan for an SBA loan or built a financial projection for a startup business? Very, very misunderstood in what a financial projection is going to look like or must look like for a startup. And so these are some very important things to remember. Your credit history and your credit score is very important. I've highlighted that as a full-blown bullet here, but as well, you can see in the sub-bullet that the 5 C's are what a bank is going to be looking at. Your character. This relates back to what kind of experience you might have in the industry. It'll also look at and apply a great deal to your credit and what kind of a borrower you are. The capacity, one of the 5 C's relates to your ability to repay the loan. So I share with folks that there's 2 gatekeepers on a loan. One, when we're underwriting and determining if somebody is bankable, the first gatekeeper is you, the individual. We want to see that you have the capacity to repay your own debt and have a debt to income ratio that's acceptable by lenders. The second gate then, once that gate opens, the second gate then is, what do you want to do? What do you want to buy? What does that look like? And then that's when the business plan and the financial projections come into play. The amount of capital that you have for the injection is obviously very important, not to wipe out your whole bank account, for example. You'll not only have the injection to put into the business, your down payment, but you're also going to be required to have what banks refer to as post-closing liquidity. And post-closing liquidity is just a reserve that you need to have set aside. Like when you buy a house, the mortgage banker wants to be sure you've not wiped out your whole bank account just for the down payment. The conditions of being able to um, to secure a loan, if you have had a good payment history, you're a good borrower with other debt that you've had and so forth. What is the condition of the brand is also falls under this category. What is the brand's history and performance? We refer to item 20 in the FDD as relates to condition of the brand, as well other chapters in the FDD too. This is when FranData actually comes into play. Put a little plug in here for FranData. We've really been pushing brands to get with Edith's team to be certified, to get a certification from FranData that banks will acknowledge as something that shows that the brand is good, that they're an acceptable brand and that they're one that the bank should definitely be comfortable with. Recently, well, at IFA, in fact, I asked Edith to meet with a bank who was there, and this particular bank was not, they weren't up to speed on exactly what the certification is. And so it ended up that Edith had about a 45-minute meeting with the bank. Just in a whim, it worked out, and now Edith is actually going to be going, if you've not gone already, Edith, she'll be going to the bank to speak to their attorney and the individual who's in charge of their SBA division. So condition of the brand and your condition as well from a global standpoint are very important. Collateral, I mentioned this a minute ago. Collateral is something that banks will look for. If it isn't there, if you don't have collateral, then we look at the entire financial composition. We don't focus on, oh my gosh, they don't have collateral. Some banks will, though. If you don't have collateral, there are some banks who will say, we don't want the deal. We don't go to that bank if you don't have collateral. The state of Texas, for example, is a homestead state. The only state in the country that has, as part of their homestead law, provision that, or provision, whatever you want to call it, that a bank is not allowed to put a lien on a primary residence. If you have a secondary residence or third or fourth, then the bank can put a lien on those. But that's the only state in the country. Every other country, the bank is allowed to put a lien on your personal residence. We can go ahead and move to the next slide. I think I'm taking up a lot of time here, but this is just something I love to talk about. One of the things that we do at Benetrends that many of you know, some may not, but 41 years ago, the founder of Benetrends designed and is what we call the architect of the ROBS transaction, where you're able to roll over funds that you have in a 401k plan or some other kind of retirement plan that has qualified funds to be able to roll over into a C corporation, and then the corporation is allowed to invest in the company tax and penalty free. This is a great way to be able to cover your injection, for example. Some folks will use the ROBS transaction to cover the entire cost of the franchise, and that's great if it makes sense. But you've always got to think about, if I use and wipe out my entire retirement to buy the business, what do I have in reserve? What kind of savings do I have for me to be able to grow the business in the future? How am I going to get number 2 and number 3 open? So sometimes it makes more sense to use some of your rollover liquidity as the injection amount, and then do an SBA loan along with the ROBS transaction, which is very, very common. It's very important on that note to maintain a very strong personal balance sheet. As I mentioned earlier, there's the first gatekeeper, you. Have a strong personal balance sheet, because that is going to make you a stronger borrower with more leverage for a bank. You're going to be a lot more attractive. The liquidity from a RODS transaction can actually be used for income. So we have folks who come to us and they don't have a job. Neither the husband, the wife, or if they're single, they don't have a job. If they have enough liquidity in the ROBS, if they do a ROBS transaction and from their retirement, if there's enough liquidity there, that liquidity can be set up as a reserve, set aside to be the supplement for income. And the income is so necessary because there's the debt to income ratio that's part of that first gatekeeper. And that test has to be passed. You don't have a job, but you have liquidity in your ROBS. Let's use that as your income. And providing there's enough there to build the reserve or to have a reserve for income, then we can move on and that gate opens and we get to the second gate. And then, of course, lenders allow funding to a C corporation. So having a C corporation is one of the rules in doing a ROBS transaction. And a lot of folks will say, well, I heard that a lender cannot fund to a C corporation. The lender can, and it happens all the time. Some frequent comments we've heard, I've shared a lot of them with you already, but everyone I talked to scared me about getting an SBA loan. Happens a lot, and it's unfortunate. I always enjoy sharing with folks about how wonderful the SBA program is, because it does work and it does not have to be scary. It does not have to be something that you're afraid of seeking out. My neighbor told me they didn't have to use their home as collateral. My neighbor told me they only had to put in 5%. Well, we can't go by what the neighbor says, because that's the neighbor's financial composition. That's not yours. Every single borrower is in a different financial situation. And then, of course, I heard getting an SBA loan can be brutal. It can be, but it doesn't need to be at all. Go ahead and move to the next slide, please. So just a few more quick notes here. Every bank has their own lending criteria. I mentioned that earlier. The SBA has their guidelines that a bank must adhere to and follow. However, every bank has, as I put it, their own personality. And tomorrow morning, the board of directors might change their mind, and all of a sudden their criteria changes. So it's all about what the bank is willing to do, as long as they're following the SBA guidelines. We always encourage folks, of course, to work with an expert. There's a lot behind the curtain that needs to be maneuvered. And if you've never done this before, it obviously helps if you've got have an expert who's been doing this for decades to be able to help you through the process. Acquisitions are definitely very possible to secure lending for. We do a lot of acquisition projects. You're looking at an existing business, an ongoing concern. We can definitely analyze that business historical performance and determine if it's bankable. When going through an acquisition, funding for an acquisition, there actually becomes a third gate. It's you, it's now what is it that you want to do, and then third, looking at what the existing business that you want to buy and how they're performing. Existing business owners, you own an existing business already. Sometimes that's referred to by banks as an affiliated business. Your affiliated business must be profitable. We have folks come to us and they say, well, of course my business isn't showing profit. I don't want to pay taxes. Well, that's fine and dandy. I get it. I was a business owner once. However, you have to show that your existing business is profitable. Otherwise, the bank's not going to be interested in loaning for a new business. They've got to see that the one you own currently is in a good position. So the application process and documents and so forth are always time sensitive, and that's something that the expert can help you with. We can help you with as you go through the journey. And there's a barcode there that you can click on to apply for a loan with us to use either now or at some time in the future. Next slide. I think that should be about it. This is just an example of showing it doesn't need to be a complicated process. This is what we have to share with folks as being a little roadmap here. You go through a pre-qualification with us. There's the loan guidance and processing period of time. We get a bank proposal for you. We get the bank approval, and then the loan closes. So it's as easy as 1, 2, 3, 4, 5. And happy to go over that with anybody anytime. Thank you.
Okay. Yeah, great, Reg, great information. Thank you for all of that. Folks, we've got two finance experts and great friends of IFA here available to take your questions. Now, if you have questions on the lending environment or anything else, feel free again to put those questions into the Q&A. So I want to start with a question you both touched on. Obviously, we've been in a rising rate environment, a moderately high rate environment for the last couple of years, but the forecast is for interest rates to potentially decrease ahead. How will lenders likely respond to a declining rate environment? Maybe Reg, you want to go first, and then Edith.
Sure. A declining rate environment we're really not going to see. Edith can offer some color to this as well, but we're not going to see too much of a difference. The banks have their policies in place. They have their underwriting guidelines. There's certain criteria that a prospect borrower has to meet, and providing they meet that criteria, then they'll get a loan. So the interest rate doesn't have a whole lot of bearing on whether or not a borrower is qualified for financing. Of course, it's a lot more attractive for borrowers to see a lower interest rate around the corner. It is for all of us. And so that we're anticipating will drive more entrepreneurs out there to want to go ahead and move forward in securing financing. Edith?
Yeah, I guess I think that the problem with a rising interest rate environment is that lenders have to stress test against something that might be like, oh gosh, how much more could it possibly go up? So if it becomes a declining interest rate environment, then there might be less stress testing against the opposite, which is that could cost borrowers more money. So I think that's definitely would be a positive attribute for lenders to be assured of the cash flow that their borrowers would have going forward.
Yeah.
So it would be great.
That's a really good point, Edith. Some of our lenders will actually increase the rate that they have over the last year when they're stress testing, as you put it, underwriting. They'll increase the interest rate by a point to see if the borrower still qualifies or not. So that will obviously loosen up. Good point.
Excellent. Thank you both. Question here. What are the current interest rates on SBA loans? I've heard from a few franchisees that they couldn't afford the loan payments and their businesses were negatively affected. Current interest rates on SBA loans.
Current rates are based on the prime rate all the time. So the prime rate right now is 8.5. And on a startup, we're generally seeing anywhere between 2.25% to 2.75% on top of the prime. So that would put us at 11.25% today. The earlier I mentioned in the presentation that the interest rate is capped. So for a 7A loan, for example, the interest rate can be no more than prime plus 2 3/4. Lenders will adjust the interest rate every quarter. So now that we know rates are coming down, sometimes we'll hear people say, well, I want to refinance out of my loan so I can get the lower interest rate. Well, the bank is going to adjust your interest rate quarterly anyhow. So there's no sense, no reason to refinance out of it.
Great.
Edith,
Thank-
anything you wanted to add?
Yeah, I guess, that if someone had a loan previously and their rates went up, then of course that is going to affect their cash flow. But I think like lenders are very understanding, like this is a dramatic increase in rates. And so what I'm hearing is that lenders are working with borrowers to help them, get some relief and have a plan to try and drive a better outcome, maybe deferring interests. I heard a very funny statement. It was called extend and pretend. So basically like, push it out and hope for the best. But banks are working with borrowers is the point. So that's a really positive attribute, that if a borrower is proactive and constantly talking to their lender, then they can work towards a better outcome.
When in doubt, extend and pretend. Okay, very good takeaway. So here's a question, maybe particularly for our younger concepts on here. Reg, you mentioned some of the items in the FTD, items of disclosure in the FTD. Would you talk about the importance of disclosure in the FTD and accessing lending? Maybe Reg, you
Sure.
first, and then Edith.
Sure, Mike, that's a great question because there are certain items in particular. The entire FDD is something that the bank is, of course, interested in, but there's certain items in particular, like item 7, item 20, item 19, that a bank will really focus on. Item 19 is a disclosure of financial information that the brand has experienced over a period of time. If there's an emerging brand and they may only have a few locations, or maybe they have one, then item 19 is something that's not going to be, there's not going to be much beef there for the bank to review and to look at. So emerging brands are sometimes, can be a little bit more difficult for financing with some banks. But then there are banks, of course, that will definitely do emerging brands. And in an emerging brand situation, if there's nothing really to show in item 19, we'll work directly with the brand in identifying what corporate locations have done, any existing locations that they have open, and then we'll use that information to help us not only build the financial model and the business plan, but help the lender understand, hey, this is an emerging brand, but look at what the existing locations have done. In item 7, which is the breakdown of the startup expenses, we always want to refer to that. Sometimes there'll be a range. Well, there's always a range in item 7. Let's say it's 250 to 600,000. We'll have somebody come to us and say, well, my project cost is going to be $1 million. Well, the cap in the FDD in item 19 is 600,000, and that's what the bank is going to be focusing on. Why is your project cost going to be $1 million? Oh, well, I'm going to buy real estate. I'm going to buy an existing building. I'm going to buy dirt and construct a building. This happens often. Well, if the brand has not accounted for somebody buying real estate in item 7, then that's explainable, and that's going to be just fine. Otherwise, we've got to stick within the range in item 7. So those are just a couple of little examples.
Very insightful.
Yeah, I'll just add really briefly. I looked at 1,000 brands, emerging brands, recently, and 80% of them had some level of earnings disclosure in their FDD, and about 20% had some level of unit profits. So I think that is a different view than when we look at the entire universe of franchising. So emerging brands, you have to have more information if you want a bank to think that you're someone who's going to buy that business will actually have the chance to be successful.
And emerging brands don't, yeah, I think Edith, you probably busted this myth earlier, but do not shy away from franchisees, prospect franchisees who need financing. Over the years, we have helped many, many, many emerging brands with financing for their franchisees. There was one brand that we did last year. It was their very, very first location, franchise location, that we secured financing for. So let's always take a look at it.
That's great. Thank you both. See, Mackenzie's running our studio. Maybe she can help with this next question. It says, when will the 2024 Economic Outlook report be available? That Edith walked us through. That report is available. I'll ask Mackenzie to put that link on the IFA website into the chat function, but that report came out just last month, right before the IFA convention, so everybody can have access to all of the forecasts in the various business lines and the whole picture. Perhaps final question, Reg and Edith, that I wanted to cover was the other change we've seen over the past year is that the franchise directory at the SBA disappeared essentially last May due to a SBA affiliation rule change. What does that mean if you're not on the list, and what will that mean moving forward in the franchise lending environment, Edith?
Sure, thanks. Well, when SBA stopped reviewing for affiliation and eligibility, it basically created this risk vacuum for lenders. And so lenders say, well, hey, wait a second, I haven't been reading hundreds of pages of FDDs, and now all of a sudden I have to. So and so lenders were calling FranData to find out, like, what do we do? Are you guys going to be reviewing agreements? And the answer was no. However, there is a solution that will, we call it a kitchen sink of eligibility issues that are in one document that franchisors can sign so that a lender can go into their franchise registry account and download it to know that they're eligible. Here at this conference, we got called out in a breakout session called Jive Talking, a peer-to-peer chat. And essentially, the question was, they wanted all the lenders in the room to know that it's easier for them to deal with eligibility issues for brands that haven't been on the directory, and for those that were on the directory, that they are still eligible. And so we've seen lenders now requiring it as part of their process because it takes away risk from them making an eligible SBA loan.
This is in reference, Edith, right, to the certification that I mentioned earlier?
Yes, that's right.
Great. Well, we will, thank you, Edith. We will let that be the last word. And I tried to enter the franchise outlook into the chat. If you can see that, that's great. If that doesn't come through for you, you can quickly Google 2024 Economic Outlook and International Franchise Association, and that'll come right up the page on our screen. And sorry if that's not handy, but I want to thank everybody for being here, and I want to especially thank Edith Wiseman of FranData and Reg Bird of Benetrends for sharing their expertise and starring in today's program. Again, you can find this recording, folks, if you'd like to share it with colleagues at community.franchise.org. Thanks again for being a part of today's program. Hope you found it helpful, and hope everybody has a great rest of your week.
Thank you very much.
Thank you.